Hey everyone, welcome back to the channel. Today, we're diving into a topic that sounds complicated, but is absolutely crucial for anyone planning their retirement. We're talking about something called sequence of returns risk. Now, I know what you're thinking. That sounds like something out of a finance textbook, but stick with me. This concept is so important. It's often called the retirement killer, and understanding it can be the difference between a comfortable, stress-free retirement and one filled with anxiety. So, what exactly is it? Imagine two friends, let's call them Sarah and Tom. Both are retiring today with a $1 million portfolio. They've invested in the exact same funds. And over the next 30 years, their investments are in the exact same average annual return, say 7%. You'd think they'd end up in the same financial position, right? Well, not necessarily. And this is where the sequence of returns risk comes into play. It's not just about the average return you get over time. It's about asterisk. When asterisk, you get those returns. The order, or sequence, of your investment returns matters immensely, especially in the years right before and right after you retire. Let's break this down with Sarah and Tom's story. They both plan to withdraw $40,000, adjusted for inflation, each year to live on. In our first scenario, let's say Sarah retires, and the market does great for the first few years. Her portfolio grows nicely, even with her withdrawals. She gets strong, positive returns early on, giving her portfolio a solid cushion. So, when a market downturn eventually happens a decade later, her portfolio is large enough to weather the storm. She's in a good position. Now, let's look at Tom. He retires at the same time with the same amount of money and makes the same withdrawals. But in his scenario, the market takes a nosedive right after he retires. He experiences a series of bad returns in his first few years of retirement. Think about it. He is withdrawing money from a portfolio that is also shrinking due to market losses. This is a double whammy. He's selling assets at low prices to fund his living expenses, which permanently depletes his principal. Even if the market roars back later in his retirement and he ends up with the same average return as Sarah, the damage is already done. His portfolio was hit so hard at the beginning that it may never recover. He could run out of money long before his 30-year retirement is over. This is the devastating power of sequence of returns. Risk. Good returns early in retirement can set you up for success. Bad returns early in retirement can derail your entire plan, even if your long-term average returns look good on paper. You are most vulnerable to this risk in what financial planners call the retirement red zone. This is the period about 5 to 10 years before you retire and 5 to 10 years after you retire. During this window, a significant market downturn can have a disproportionately large and lasting impact on your financial future. So, why does this happen? It's all about the math of withdrawals. When you're still working and accumulating wealth, you're adding money to your portfolio. A market downturn during this phase can actually be a good thing. You get to buy more shares at lower prices, a strategy known as dollar cost averaging. Your new contributions are buying in cheap, setting you up for bigger gains when the market recovers. But once you retire, the dynamic flips completely. You're no longer adding money. You're taking it out. This is called the decumulation phase. When you sell assets in a down market to generate income, you're locking in those losses. You have to sell more shares to get the same amount of cash, leaving fewer shares in your portfolio to benefit from the eventual recovery. This is what happened to Tom. His early withdrawals from a shrinking portfolio created a downward spiral that was very difficult to escape. Okay, I know this sounds a bit scary, but don't panic. The whole point of understanding this risk is so we can build a plan to protect ourselves from it. Knowledge is power. So, what can we do? There are several effective strategies to mitigate sequence of returns risk, and we're going to walk through some of the most popular ones. First up is something called the bucket strategy. It's a simple yet powerful concept. You divide your retirement savings into different buckets based on when you'll need the money. Your first bucket is your cash bucket. This holds 1 to 3 years worth of living expenses in very safe, liquid assets like cash, savings accounts, or short-term bonds. This is your buffer. If the market tanks right after you retire, you don't have to sell your stocks at a loss. You simply draw from this cash bucket and give your investments time to recover. Your second bucket is for your medium-term needs. Say, money you'll need in 4 to 10 years. This can be invested more conservatively than your long-term funds. maybe in a balanced mix of bonds and some stocks. It's designed to generate modest growth, but with less volatility than an all-stock portfolio. Then you have your third bucket, the long-term growth bucket. This is for money you won't need for at least 10 years or more. This bucket can be invested more aggressively, primarily in stocks, because it has a long time horizon to ride out any market ups and downs. The bucket strategy helps ensure that you never have to sell your growth assets at the worst possible time. Another powerful strategy is to establish a flexible withdrawal plan. The classic 4% rule, which suggests withdrawing 4% of your initial portfolio value each year, is a good starting point, but it can be rigid. A more dynamic approach is to adjust your withdrawals based on market performance. In years when the market is up, you might take a little extra, perhaps for a nice vacation. But in years when the market is down, you tighten your belt and withdraw less. This is called a guardrail approach. For example, you might reduce your withdrawal by 10% if your portfolio value drops significantly. This flexibility can dramatically reduce the strain on your portfolio during bad years and significantly increase its longevity. It gives your investments a chance to breathe and recover. A third strategy is to secure a reliable income floor. This means creating a baseline of guaranteed income that covers your essential living expenses. Things like housing, food, utilities, and healthcare. This income isn't dependent on the stock market. Where does this income come from? Social Security is a big one. Delaying Social Security until age 70 can significantly increase your monthly benefit, providing a larger, inflation-adjusted income stream for life. Other sources can include pensions, if you're lucky enough to have one, or an immediate annuity, for example, allows you to give an insurance company a lump sum of money in exchange for a guaranteed monthly paycheck for the rest of your life. By covering your basic needs with guaranteed income, you reduce the amount you need to withdraw from your investment portfolio, making you less vulnerable to market swings. Any money you pull from your investments can then be for discretionary spending, which is easier to cut back on during a downturn. Finally, let's talk about asset allocation as you approach retirement. In the years leading up to your retirement date, it's often wise to gradually shift your portfolio to be more conservative. This doesn't mean selling all your stocks and hiding in cash. You still need growth to outpace inflation. But it might mean reducing your stock allocation from, say, 80% down to 60%, and increasing your allocation to high-quality bonds. Bonds tend to be less volatile than stocks, and can provide a stabilizing force in your portfolio during a stock market decline. This process, often called a glide path, helps de-risk your portfolio as you get closer to that vulnerable retirement red zone. So, to recap, sequence of returns risk is the danger that poor market performance early in your retirement can deplete your portfolio much faster than planned. It's a serious threat, but it is manageable. By using strategies like the bucket system, having a flexible withdrawal plan, creating a guaranteed income floor, and adjusting your asset allocation, you can build a resilient retirement plan that can withstand the inevitable market storms. Retirement planning isn't just about accumulating a big pile of money. It's about making sure that money lasts for your entire life. Understanding and planning for the sequence of returns risk is a non-negotiable part of that process. It's about shifting your mindset from wealth accumulation to wealth preservation and distribution. I hope this explanation has demystified this important topic for you. It's one of the most important concepts to grasp for a successful retirement. If you found this video helpful, please give it a thumbs up and consider subscribing for more content on building a secure financial future. And as always, leave your questions and comments down below. I love hearing from you. Thanks for watching, and I'll see you in the next video.